we've been talking about the PFI. We put the indicator on here. First of all, the PFI is the red line. It looks at price action and it's trend sensitive, and it tells you whether the market's in a buying mode or a selling mode. Also, the bars, the price bars here, that's based off market structure. The gold bars say it's in a bearish mode, so you want to look at sells. Green, bullish mode, look at buys. And then, of course, we look right in here, it's kind of a mixed, and that's when it'll give you neutral. Also, we've added the trend strength rating, weak, moderate, or strong. But many people have had questions and a little confused, so I thought I'd give them just a little bit of a tutorial of one thing to watch for. Because what the trend strength rating does, for example, this is a 5-minute chart in the gold. But many traders will look at higher time frames also in conjunction with the chart they're looking. So the reaction point will, behind the scenes, look at several higher time frames, monitor the price action, and based on that price action, tell you whether it's a strong downtrend, moderate downtrend, or weak. Weak mainly means it's just the beginning, it's shifting to a new trend. Now that stands to reason that if you have, for example, a 5-minute and then a longer time frame and a higher time frame, and they're all pointed down, it stands to reason that it's going to be a strong downward trend. And of course, on a strong downward trend, for example, right here, if the market comes up to the PFI and then it says you look for sales. Strong trend, you look for sales. Also, but that's one indicator. We have many things, and one, of course, or the main one is action reaction, using the price action, past price action, to project forward price action. And that's where the counts come in place. And if it'll give you a reaction zone. Well, what I've done here is I've marked on a 5-minute chart, you'll see the big red box right here, this one right here. That is the reaction zone of a 30-minute chart. The blue box inside of it is the reaction zone of a 15-minute chart. The one inside right here, that is the reaction zone of a 5-minute chart. They're all coming together. So that's one thing I want to watch, tell people. So we're looking at, and of course when this was going down, it was a sell. It was a strong sell, and the market's coming down into this area. Well, what are the first thing? Reaction point. When the market trades lower into a reaction zone, we are expecting the market to turn, get a reaction, which usually results in a move higher. Okay, that's one thing to watch for that we teach. Next thing is then we add our pitchfork, because we want to look at the median line support. Put it right there. So what do we see? The market has come down and it's touched the line here, touched the line here, touched the line here, and then moved up here. So it is finding support. It's moving down into the reaction zone, and it's reached its target objective in the reaction zone. Here's our action line, which, whoops. Let me get that reaction line. I pushed the wrong one. I want to do this one here. There we go. So action reaction puts you down where this lower line, the median line, intersects with this action line, and right here, this is our target objective. So time and price come together. You have recurrent time frame and then two higher time frames coming together. So that's a cluster. That could be a very significant turn. One other thing that we teach in the course is you look at this. Look at you, 1, 2, 3. 3 and out. We talk about 3 and out. So there's 3 swing patterns and out. That's another thing that says, okay, there is a major, something major. All right, so just to follow through or show you what happened. I hit the wrong button. Okay, all of a sudden right here, look what happens. The PFI turns higher. The market structure turns from gold to green. It turns from bearish to bullish, and the market makes a significant turn. So that's one thing. The PFI will look at the major time frames, I mean many different ones, and tell you that. But also it does make a difference to go back and look at those come together. So you see how the longer time frames and them coincide for major turning points. And that's just another thing that the reaction point will help you with. So there is your action reaction all coming together, and the market makes a significant turn right on cue.